been a lot going on here at Adams Wealth Partners. We've been at Future Proof, which is a big wealth management conference that Carson and I both attended last week, and then got the team retreat coming up this next week down in Florida. So we're gonna have some fun and some work while we're down there. But yeah, it's just been busy here, but I think busy's good.
Busy's good, and as I get older, I do feel like busyness, it just tends to be something that you think will just go away, but you just get busier and busier, and there's always something new and going on and everything. But
I feel like in every meeting I've had for the last 3 days, like which is probably like for sample size, like 6 or 7 meetings. I think everybody sitting across the table has said there's just so many unexpected things that have been popping up that we've had to pay for. And I'm like, that's literally everybody that sits across that side of the table. I think life is just feels like it's going fast and it's expensive and there's a lot of stuff going on.
that's right. Yep, it is. It we talked about budgets last week and that sort of thing, and that's um, there's just you always have to have that miscellaneous category in budgets, but yeah, same thing with life. There's always something going on. And talking about future proof, that was probably one of the biggest wealth management conferences out there. It was in Huntington Beach, California, and that was easily the best conference I've ever been to. Not only was it extremely good content and we learned and networked with a lot of people, but it was outside and it's in a parking lot. But the fact that you're outside at a wealth management conference and you're not in just a stuffy conference room or a convention center, the amount of energy that brings just to the atmosphere and your ability to learn it's unlike anything else. Plus, I mean, it was sunny and 75 every day.
Yeah, we've been in a ton of those before in the past, and you're usually in a freezing cold, massive ballroom. And I think the fact that it was outside, like I just didn't feel as tired at the end of the day. We came back with a little sunburn also, so I think
Didn't realize we were getting
most of the
sunburned, but
office
we
maybe
did.
thought we weren't out there working. We were hanging on the beach, but I can say with 100% accuracy that our feet did not touch the sand while we were out there, even though it was right on the beach,
True.
which
Probably should have.
sounds kind of boring of us also, I would say.
Yeah. Maybe we got to live a little next time.
So, but no, I think, just thanks for joining us again. I'm Miles, a wealth advisor here on the team, joined by Carson, another wealth advisor here on the team. And I think the talk of all the unexpected coming up and time flying by, people and talking about how last week we spoke on budgeting really kind of ties us into what we're talking about today. And that's how much cash is the right amount to have on the sidelines. And this is without 100% certainty, not a one size fits all approach to anything. I think
One of
this
those
is
classic, it depends
yeah,
situations.
it's very dependent on family, what you have going on in your life, what you want to do. I mean, I sat with some
Mhm.
clients yesterday looking at retirement a couple years out, and they were just like, we don't want to travel. We want to go hang out at the lake and enjoy our boat. And that creates a very different amount of cash that needs to be available and set aside for other than somebody who wants to go to Europe once or twice a year and take the family and things like that. So with that, not a one size all fits approach, very individualized and very different for everybody out there.
Plus, I think this conversation has gotten a lot more popular. People have taken on additional cash with interest rates being higher the past 2 or 3 years, and all of a sudden you're like, a while ago it was I can get 5% in money market. Oh my goodness, that feels so good after having a decade longer than that of rates at zero. Like you literally would maybe get a couple of pennies, even if you had $1 million sitting in a bank account, just basically nothing. So it feels really good. But now we're in this environment of rates falling. Just recently, the Fed cut rates 25 basis points, and they're probably going to continue to do that. So your yield on your cash, it's better than what it used to be, but it's not your key to long-term success in a financial plan. But that's not the purpose of cash a lot of times. So we can kind of dialogue and talk about cash, how much you should have. But again, it depends. But I think from a foundational standpoint, we can always get behind having 6 to 12 months worth of living expenses in cash in a savings account / money market set aside.
And I think that's increased. I mean, I think a couple of years ago, people were saying, you should probably have 3 to 6 months. And I think post COVID, that amount, yeah, I think we're all kind of more in the 6 to 12 months camp now, especially with everything just costing much more.
Now, could you do 3 months? Could you have 2 months? Sure, absolutely. That you could get away with that. You have an extremely safe income source, or you are retired. It doesn't necessarily mean you need a ton of excess cash. but I think a general rule of thumb, a soft target for a lot of people can be 6 months worth of living expenses in a savings account. Um, it will better prepare you for an emergency.
And then I think with the way, yeah, that should carry most people. And I think the way we plan also with most people is, in addition to that, if you know you have big expenses coming up in the next 12 months or so, just beginning to prep in advance for those so that that money isn't at the mercy of the stock market and the unknown. On average, it's up about 3 out of every 4 years, down about 1 out of every 4. But the worst thing you can do is have that money in the market and it's a year the market's down and you have a little bit less cash than you thought you had.
You're going to have a big expense coming up in the next 12, 24 months. Keep it in cash. There's not a lot of uh, logic behind investing stuff you're going to need. I mean, risk tolerance matches time horizon. So you have an extremely short time horizon. Risk tolerance needs to be next to nothing. Therefore, cash in the bank. You've got a 20-year time horizon. That's an extremely long time. Your risk tolerance can be more aggressive. But specifically about cash here, I think we can kind of set that foundation of make sure you have emergency fund covered, make sure you have your big expenses in cash in the bank or in a money market or something with a good yield. Now, what about dry powder? What about, okay, you've got your emergency fund covered, you've got your retirement accounts you're funded, you've got what we call your bucket two, your brokerage accounts you're investing in. How much cash should you have above and beyond that? That's a loaded question, and that's not an easy question to answer because it's going to be different for everybody. It depends. Enough said, end of podcast, it depends. But kind of the logic behind the answer of it depends is because if it's from a market timing perspective, uh, there's been a study that's been done. I wish I could cite it. I can probably go back and look it up. But essentially, it was if you were basically giving $1 million now, would it ever be better to slowly dollar cost average over a few months, or is it better to just lump sum throw it all into the market all at once? And I think basically there are times when both work where you end up being better off dollar cost averaging, or are you going to end up being better off just throwing it all into the stock market all at once? I think the result of that scenario ended up saying more times than the other, if you just throw it all in the stock market all at once, you're going to end up being better off 12 months later. Now, why is that? Because like Miles said, 3 out of 4 years the stock market's up over a 12-month period. Well, if that's the case, then you've already got a 75% chance that your money's going to be going up over a calendar year. Now, past performance doesn't predict future results. It could be the time where the next 12 months the stock market starts going down a little bit. You can take advantage of that. And if you're dollar cost averaging, you get a better entry point as the market goes down and down. The bridge of that is the emotional side of it. Investing is emotional. Money is emotional. It's just whether or not we let it indicate our decisions and to what degree are those decisions impacting our entire financial plan. If you've got 80% of your financial plan in cash and you've got $800,000 in cash and $200,000 invested of your $1 million, that is a long-term issue, but it can be resolved by getting your money more productive. If you've got $1 million in cash of your $15 million investable net worth, yeah, that's a lot of cash. However, grand scheme of things, if 14 million or is invested, you're okay. It's a smaller percentage of the overall financial plan. That's how I kind of think through the it depends situation.
Yeah, I was letting you run there. That was well said. But yeah, I mean, to your point, it's like historically speaking, the best time to invest has been when you've had cash, whether the market was at all-time highs or the market was at all-time lows. Certainly your return perspective looks a lot better if you bought the market when it was down 20% and then it recovered that same year, like we've seen with a couple of these last past corrections in 2020 and I mean even earlier this year in 2025. But somebody who put cash to work at the peak of the market in 99 and 2000, just before the market crash, still has more money than they had than if they would have left it in cash by, I mean, by I don't know, by a wide margin. I'm not even going to say a percentage because it's probably people wouldn't even couldn't even imagine what that percentage looks like. So even when people have bought at market highs in the past, much better off putting that in the market. I mean, the market is making, on average, the market is making way more new highs than way more lows. And so the market is, historically speaking, climbing at a much more rapid pace than we're seeing market declines. And I do think those market declines are a good opportunity to try and put cash to work. And that doesn't have to look like you are sitting on fresh, actual cash in your checking savings account. It could be maybe you're an investor who's 75-25 and you don't have a lot going on and you're young and you can afford to take a bit more risk. So you bump your allocation from 75-25, that 25% being in bonds, to 85-15. And you just moved effectively 10% of your portfolio into stocks at a lower point. And so there's ways to get creative like that. And I think working with a professional who can help you see those and come up with those is to your benefit, because they're going to see things and think about things, and it's something they're doing every day, whereas you're most likely focused on your family and your job and things outside of this world, who can give you that perspective and find ways to help you get creative to take advantage of those pullbacks.
That's good. That's good. And realize this conversation, it depends. There's a black and there's a white scale, and you can be on, the two extremes. A, having way too much cash, of having, hardly any investments and way too much cash. You can have way too little, running off of $100 in a savings account and not being prepared for an emergency expense at all. I think we can both agree that those are two extremes that you don't want to find yourself at. And there is this massive gray area between the two, of being more heavier tilted towards cash, more heavier tilted towards not enough cash. Doesn't necessarily mean it's wrong, but that's where the human element comes in. Everything that we do has that human emotional element to it. And I love talking about how emotions are real. Be aware of your emotions. It just comes down to, are we going to let those emotions dictate our decisions? And how much is that going to impact our financial plan? And are we okay with it? Because I say this all the time too. Back in April, Liberation Day, whenever the market was going just wacko, just absolutely crazy, it is emotional for us in this office as people who do this every single day. Our emotions are running high. We're sitting here managing $1 billion of client assets. We treat every single dollar as if it was our own, and we're doing everything we can to protect it, to grow it, to manage it in a way that clients entrust us to manage it. And whenever there's so much volatility all at once, we wear that, and we wear it mentally, emotionally, because we don't like it when things go down just as much as a client doesn't like it when things go down. But we come back to, are we going to let those emotions dictate how we invest based on history, based on what we know is going to be best for a client situation or a client financial plan? And I always give the invitation to call us and talk through those emotions. I think that's one of the best things that we have clients do, is talk to us. Hey, it's freaking me out. Like, what's going on? What do y'all think about it? I'm happy to talk through that. We can talk through that all day, because we would rather have that happen than going through and just panic selling whenever the market's going crazy. But
Yeah, and I think I have just a couple things to add to that. That was well said, but I think it's, we talked about at the start, 6 to 12 months in cash, big expenses, etc. I think the other number that works for people is whatever that number is that they like to see, that makes them sleep at. We call it the sleep at night number, whether that's $25,000 or, and this is obviously all subjective to lifestyle and incomes and things like that, but whether it's $25,000, $50,000, we have some clients who say, "Hey, if I don't have $100,000 in cash, I'm not going to be sleeping. I'm not going to be sleeping well at night." Well, if that's what they think and how they feel, then their emergency fund or cash on the sidelines probably needs to be around $100,000. Some people might think that's crazy and and say, "Hey, how could you ever need $100,000 at one time?" And maybe you agree or disagree, but if that's the number that they're getting good rest and not stressed out about money, then that's the number that's right for them. And I think the other point I wanted to make, Carson, was you were talking about, like, when things are going crazy and we're wearing that for clients. We certainly are. And I would just add to that, I think what we try to do and do a pretty good job of for clients is in times of stress like that, just bringing the conversation back to the financial plan and trying to take it off of what the stock market's doing, and just getting people to focus on, hey, if the market's down 20%, like, what does that mean? Does that mean you can't keep going out to dinner, or you can't take your family trips? Well, what if market being down 20%, like, hurts emotionally and a little bit, but you can still do all those things that you want to do anyways, because we've created financial plans with all these scenarios already at play, and it really doesn't affect things. It just temporarily causes some stress, and let's help you get through that today and feel good about where things are at, then that's what you need to do. You need to bring it back to focus on the plan and not necessarily what the stock market's doing. I think that's where a lot of people get caught up and they let their emotions run heavy with the stock market. Perfect example being CNBC right behind me here. When they run their markets in turmoil special, the market has like historically rebounded off the lows and always makes and goes on to make new highs typically. So, it's like that's what the news is supposed to do. It's there to report on all the bad stuff. And if you can not focus on that, focus on your plan, you're gonna be much happier and better off.
Exactly. Look, it's a personal thing how much cash you should have in the bank, and ultimately talk to us, talk to somebody about what should that number be. Is this too much, too little? And get some advice. Don't do it alone.
Yeah, I think we strayed a little bit from maybe just the pure cash talk like we thought we would have there,
fair.
but I think that's good because we're kind of centering it on financial planning and how to think about cash and incorporating it into your financial plan, which is obviously a big piece of it.
Mm-hmm.
So,
yep.
Thanks again for joining us. Unless you have anything to add, Carson.
No, I was just going to give a shout out to my little brother.
There you
The
go.
newest artwork here is this is Vanderbilt Stadium, and my little brother Corwin, he's 18 now, but he painted it the other week because I was wanting something to have right here in my office. So if you're watching this online or you can see it, I just wanted to give a shout out to the little bro Corwin for painting that for me.
Nice work, Corwin. I was impressed when I saw it this morning.
It's pretty good. It's better than I can do. I'm a terrible artist, so that's far beyond what I could do.
Awesome. Well, thanks for joining us. Looking forward to continue rolling with these, and we'll see you guys next week on the Retire While You Work podcast.
See you next week.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.